There's a word that's being thrown around in Washington and on the news that probably makes your eyes glaze over: tariffs. But I'm going to tell you why it might be the single most important word for your investment portfolio in 2025. In the next 6 minutes, I'm not going to give you a political lecture. I'm going to give you an investor's briefing. We'll uncover where the new risks from these sweeping global tariffs are hiding in your stocks, and more importantly, where the surprising opportunities might be. Now, I get it. You hear tariffs and you either tune out because it sounds like a boring C-SPAN special, or you immediately pick a political side. But what if I told you that for you, the investor, both sides of the argument are missing the point? This isn't theory anymore. As of August 7th, a new 10% baseline tariff on most imports is in effect, with rates as high as 50% on goods from specific countries. This is radically changing the cost of doing business for the companies you own. Understanding this is no longer optional. I've spent the last several weeks cutting through the partisan noise, digging through earnings reports, and analyzing the data to give you a clear, unbiased breakdown of what this trade war actually means for your money. Let's get into it. First, let's get the simple part out of the way. What is a tariff? It's a tax on imported goods. That's it. Think of it like this. A company imports a $500 TV. With a new 10% tariff, it now costs them $550 to get that same TV into the country. That extra $50 has to go somewhere. Either the company makes $50 less in profit, or you pay $550 for the TV. Usually it's a bit of both. This is the obvious impact, the sledgehammer. Companies that import a lot of goods, especially from targeted countries, see their profits get squeezed. We're talking about major retailers, car companies, and anyone who sells electronics. Their stock prices can and will take a direct hit as their costs go up. But that's not where the real danger is for most investors. The real danger is the hidden cost. It's the ripple effect. Your stocks are part of a giant global machine called a supply chain. And tariffs are like throwing sand into that machine's gears. Imagine a company like Ford. A tariff isn't just on the finished car from Mexico. It's on the aluminum from Canada, the microchip from Taiwan, the wiring from Vietnam, and the rubber from Thailand. A dozen different tariffs can hit one single product before it ever gets to the showroom. This creates chaos. It forces companies to ask, can we even get the parts we need? And what will they cost next month? Markets hate uncertainty more than they hate bad news. This chaos forces companies to spend billions of dollars to move their factories and find new suppliers. That is money they aren't spending on innovation or paying you dividends. It's a multi-year drag on their growth that you won't see in tomorrow's headlines, but you will feel in your portfolio's returns 3 years from now. So, with prices for consumers expected to rise by an average of over $2,000 per household this year because of this, and the economy expected to slow down, what do you, the investor, actually do about it? This is where you get an edge. While everyone else is arguing politics, you need to act like a detective and look under the hood of your investments. This is not about timing the market. It's about understanding your risk. Here are 3 politically neutral questions you must ask about the companies you own. 1. Where do they sell their stuff? Look up a company's geographic revenue. A company like Dollar General, which sells almost exclusively inside the U.S., is far more insulated from foreign retaliation than a company like Nike, which relies heavily on sales in China and Europe. 2. Where do they make their stuff? This is the big one. Does the company own its factories, or does it rely on a complex web of suppliers in tariff-heavy regions? Companies that are moving production to friendly countries like Mexico or bringing it back to the U.S. might have higher costs now, but they are reducing their risk for the future. They are the ones to watch. 3. Who sells the shovels? During the gold rush, the people who made the most consistent money were the ones selling the shovels and blue jeans. In this great supply chain reshuffle, who are the shovel sellers? Think about industrial real estate in North America, robotics companies that help automate new factories, and logistics companies that manage all this new complexity. These sectors could quietly boom while everyone else is panicking. Look, tariffs are a complicated tool with massive economic consequences. They create clear winners and losers. But as an investor, your job isn't to judge the policy. Your job is to understand it and position yourself to protect your capital and find opportunities. If you got value out of this breakdown, hit that like button and subscribe right now because my next video is a step-by-step guide on how to find a company's supply chain in 5 minutes using free tools. You don't want to miss it. Trade policy will always be a political football, but you don't have to be the ball. Be the investor who understands the field. Invest smart.